Reasons for RBI imposing penalty. The penalties have been imposed in exercise of power vested in RBI under provision of Section 47A(1)(c), read with Section 46(4)(1) and 51(1) of the Banking Regulation Act 1949 as applicable. This action is based on the deficiencies in regulatory compliance and is not intended to pronounce upon the validity of any transaction or agreement entered into by the bank with their customers. Details reveal that penalty has been imposed for breach of provisions related to lending to non-banking financial companies, loan and advances statutory and other restrictions, creation of a central repository of large common exposure across banks, the circular on reporting to Central Repository of Information on Large Credits and operating guidelines for small finance bank. Further, the fines also pertain to contraventions of provisions of Section 19(2) and Section 21 of Banking Regulation Act 1949. Section 19(2) of the Banking Regulation Act 1949 bars bank from holding shares in any company, whether as pledgee, mortgagee or absolute owner of an amount exceeding 30% of the paid-up share capital of that company or 30% of its own paid-up share capital and reserves, whichever is less. Section 21 of the Act prohibits bank from granting loans or advances on the security of its own shares or entering into any commitment for granting any such loans or advance on behalf of any of its directors, any firm in which any of its directors is interested as partner, manager, employee or guarantor, any individual in respect of whom any of the directors is a partner or guarantor. Size of fines, a wake-up call for banks. Most banks do not believe that their usual business actions could cause breaches of customer privacy, facilitate money laundering, trigger a systemic failure, or result in a crisis with profound social costs. However, statutory inspection for supervision evaluation conducted by RBI prove that the contrary is true. Banks have been violating norms relating to cyber security in banks, financial services provided by the banks, financial inclusion, access to banking services, basic saving bank deposit accounts, fraud classification and reporting with impunity. Higher fines act as a deterrent to such wanton breaches of regulatory directives. Lessons and prevention measures to be adopted from imposition of penalties. Imposition of fines and penalties have a positive side to it. Post-operative analysis reveals more than what was concealed. A glaring need to update and comply with regulatory mandates and internal financial controls. Pressured employees cross-selling products lead to lapses in KYC norms and due diligence. Large gaps in information security and anti-money regulations. Banks need to complete a thorough redesign of data architecture, re-engineering of processes and modernization of system applications and information technology infrastructure. Risk management and compliance programs should include customer due diligence and enhanced due diligence. Identify vulnerable areas, weakness of the bank which are likely to be penalized by the regulator for possible contravention or non-compliance and undertake remedial measures to plug these gaps. Avoid fines and penalties. How to comply with regulatory compliance. Once a penalty has been imposed, it calls for a soul searching. A number of questions need to be answered to search for a resolution and prevent future recurrence. Number 1, gravity of and nature of penalty imposed. This criteria looks at overall picture, what happened, how did it happen and why did it happen. It also takes into account the number of people affected, damages suffered and how long the violation took to resolve. Number 2, intention. Was the violation intentional or as a result of negligence? Number 3, precautionary measures. Did the bank have any safeguard, privacy policies or protection in place? Number 4, mitigation. Did the organization at fault make any attempt to alleviate the damage suffered by people affected by the violation? Number 5, history. Does the organization have a history of non-compliance? What was the severity and frequency of past violations? Number 6. Notification, reporting. Did the bank proactively report the violation to the supervisory authority? Number 7. Aggravating, mitigating factors. This criteria pertains to any other issue arising from the circumstances of the case, including financial benefits gained or losses avoided as a result of the violation. To conclude, we can say that some people argue that penalties are an occupational hazard, but they do not have a monetary impact. The hard work put in by the employees and management to nurture loans and advances and earn income is frittered away due to negligence and failing to comply with regulatory norms. This vulnerable area needs to be plugged at all costs. It should be a common concern of the bank's compliance and supervisory authorities to prevent deficiency in the financial system that may threaten the safety of the assets entrusted to bank or harm the stability of the banking sector and the economy. As a banker, the best policy is to abide by the rules and regulations of RBI and not to give any opportunity for imposition of penalty, contravention of non-compliance with directions issued by our regulators. Thank you.